welcome to Legacy Private Trust Company's 2023 Economic and Market Overview. This is our first half recap and second half outlook. My name is Greg Hansen. I'm the Managing Director of Trust Investments for Legacy Private Trust. And joining me on the call today is Connor O'Brien. And Connor is a Trust Investment Officer here and one of our portfolio managers.
Yeah, so it goes without saying, Greg, that 2023 has been just a complete reversal from what we saw in 2022. It's been the story since the October lows. Markets have been on an absolute tear. It's the 13th best start to the year ever for the S&P 500, up almost 16%. The Dow, which is a little bit heavier in healthcare and financials, up just shy of 5%. But really the story was the NASDAQ and tech stocks really in general. It's the best start to the year ever for the NASDAQ 100. It's up almost 40%. And if you look at the right-hand column there, we are back within spitting distances of all-time highs, especially in sort of the large cap space. It seems like there's this market zeitgeist out there that's just sort of, the markets have been terrible and things aren't good and it'll be great when the markets come back around. It's just not true. Even going back a full year, back to last summer, returns have been really, really solid. Small caps, as measured by the Russell 2000, have been sort of trying to play catch up recently. They were hit pretty hard back in March and April with the failures of Silicon Valley and Signature and First Republic. But since the end of the quarter here in July, small caps have had a decent run. Bonds are green, which is more than you could say, at least for last year when they were down 15%. Inflation has been stickier, specifically core inflation. It's been a headwind for bonds. And commodities have had just a really tough go here. Pretty much everywhere you look in commodity land, energy, ag, the industrial metals, copper, so on and so forth, it's all well off the highs of 2022. As I said, obviously the story here is tech, right? Going back to the NASDAQ, it's loaded with tech. And if you look at these 7 names here, NVIDIA, Meta, Tesla, Amazon, Apple, Microsoft, Alphabet, those make up 55% of the entire NASDAQ. And look at some of the monster gains there. NVIDIA up almost 200%, Meta 140, Tesla above 100. And you see Amazon, Apple, Microsoft, Google, they're all up 35+%. It doesn't look like it because of the returns of the other names, but just really, really huge years. We're talking about almost $4.2 trillion in market cap increase just for these 7 names. And it's funny because over the last decade and a half, all we've heard about is how tech stocks are a zero interest rate phenomenon, right? And once interest rates go back up, tech will be dead. And, once the Fed starts raising rates, don't fight the Fed. Well, we just had the fastest rate hiking cycle probably of all time. And, look at the results. There has been concern really regarding how concentrated the markets become, because these are some of the biggest names out there that have just gotten bigger. We're talking about some pretty narrow leadership here. And really the mega cap stocks returns have been sort of ho-hum this year, I guess, besides maybe travel stocks. So there's been talk of how unhealthy this market is. Unhealthy is a word you kind of hear about a lot. I guess my response would be sort of twofold. One is the market isn't a person. If you own these stocks, you should be happy no matter where the returns came from. Your account value is going up, and doesn't matter whether it was these names or other names, your account value is going up. It's certainly a good thing. The second and probably more important is that when you look at these 7 names, it's a lot more than just 7 companies, right? Let's use Microsoft as an example. Microsoft has Microsoft Office, which is the bread and butter of Microsoft. It's what made Microsoft. It has Azure and cloud computing. It has LinkedIn. It has Skype. It has a $1 billion advertising business. It has Bing. It has Xbox and Activision and gaming. I mean, these are companies that own hundreds of multi-billion-dollar franchises. So when you think about sort of these individual companies leading the way, it's more than just 5 to 7 businesses. Look around you, right? You have your iPhone. We're using Microsoft Teams right now. It's Amazon Prime Day. You'll probably buy something on Amazon. These companies permeate our lives, and the list goes on and on to show that this really isn't just 7 companies leading the way. It's many, many franchises and businesses that have done phenomenally well. So, Greg, we've talked about market returns year to date. Can you tell us a little bit about why that has happened, and then move on to sort of what we see for the rest of the year?
Sure. Thanks, Connor. So I think a big thing that's happened this year is that the economic data has come through much better than feared. And the reason I say feared is that going back to last summer, we had all these scares about inflation and the Fed raising rates as quickly as they were, what that was going to mean for the economy. We've always tried to separate the markets and the economy here at Legacy. So the economic data last year was bad. The markets tended to not do as well last year as a result of that. But as we get into this year, we've seen economic strength, not a rip-roaring economy, but we have seen the economy continue to stay above a recession level. And the forecasts that were out there for the economic data at the beginning of this year were so pessimistic. The slide on the screen looks at what was being forecast relative to the numbers that actually were reported on various economic indicators. And you can see that the actual reports were far better than those estimates that were being put out by the large firms. So as we've gotten better data, it looks like a recession is further away. Last October, I would say the markets were priced for an imminent recession, and that just hasn't happened at this point. So I think that's been a big driver in what's happened with equity returns this year. You had everybody positioned very negatively. And then heading into the year, as the economic data got better, more and more firms have had to chase this rally. As we've seen stronger economic data, I think that has some implications for what the Fed is doing and will do going forward. Go back to 2022, and we saw 500 basis points of increases from, say, March of 22 through about March of this year, one of the fastest and steepest rate hiking cycles in Fed history. Where we are now, we're seeing that the markets are pricing in maybe one or two more hikes before this whole thing ends. But largely, the economic or the rate hiking cycle is behind us. The black line here shows what the Fed is projecting in their summary of economic projections, the so-called dot plot. They're basically saying that there'll be a couple of more hikes here. We're going to level off at those levels, and then maybe there'll be rate cuts in 2024 as the economy slows from the action that they've taken. A month or so ago, even, the Fed funds futures, which was the market's prediction for what the Fed would do, was showing a much more, I'll call it, bearish forecast, where markets were saying, okay, you might get one more rate hike right now, but if you do that, you're going to have to be cutting rates prior to the end of this current year. Jump forward a month at the end of June, and we're seeing that the market has come along to the way of the Fed's thinking, largely based on those economic surprises that are continuing to come through. The markets are saying, okay, you can probably have at least one, maybe two more rate hikes, and you may not need to cut all that quickly because although it's not a super strong economy, it's much better than what we were anticipating, and it's still a growing economy. And when we started a year like this, what tends to happen is strength follows strength. Through the end of the first half of the year, and going back historically here to the 1950s, when you see the S&P 500 up more than 10% in the first half of the year, often the remainder of the year is very strong. It doesn't happen in every case, but you can see from the table here, the number of times that it does happen far outweigh the number of times that it doesn't happen. So as Connor mentioned, we were up about 16% first half of the year. And the next month when that's happened, 10% or more, on average, we see about 1.9%. The median is up about 2.7%, and this happens about 63% of the time. So if we're trying to make a 1 month forecast, odds lean a little bit in our favor of equities being higher this month. But as you go out to 3 and 6 months, and certainly 12 months, the longer the time horizon after a strong start like that, the more likely we are to see continued strength in the equity markets. 6 months after a strong start to the year, the average return for equities is up 7.7, the median up 10%, and this happens about 80% of the time here. So we're not making a real wild forecast. We're kind of being in line with what market history shows and just saying we think the second half is likely to continue to be strong for equities. We may see a little bit of a give back from the top names that Connor was talking about, the big seven, tech names, and that would be a healthy development from our point of view, to see more of the smaller names in the S&P 500 or even the small cap names outside of the S&P 500 start to outperform or join this rally. So the indices continue to go higher, even though the leadership changes from what we saw in the first half to the second. But looking forward here, we think things are likely to continue to be very strong, and that's the way we're positioned heading into the second half of the year. If you'd like any additional information on this presentation, or if you have specific questions, please don't hesitate to contact your legacy advisor. If you're not a current client, please feel free to reach out at the number or email address listed on the screen. We'd be happy to start a conversation with you. Thank you for joining us today. Have a good day.